Thank you, everyone. John, Steve, thanks for joining us. We want to take a few minutes here to talk about bringing simplicity and transparency to help drive affordability and accessibility in housing. One of the things to lay the foundation is it costs about $8,000 in the most recent MBA numbers to originate a new loan. So housing finance is a big problem where it's a very expensive, very complex system, and it creates a very expensive process for consumers to go through. One of the things that our belief and one of the things that we've all worked together on as partners is driving that cost down through better technology. And so we have these fine folks running policy and running policy at MBA, Fannie Mae and MBA to help talk about that discussion. So tell me about Fannie Mae. What's Fannie Mae's perspective on simplicity and transparency, and how do we drive that?
Yeah, happy to. Thank you very much, Nima. Thanks, everyone, for having me here. So, of course, a core part of Fannie Mae's mission is to focus on affordability. And the primary way we do that is by providing liquidity to our partners, lenders who are making loans every day, and making sure that the capital markets liquidity is very, very strong. But I want to talk about two ways that we've really been focused on affordability in the last year. The first is an issue that Nima, you raised, is about the complexity and the cost of underwriting a loan. And so we've spent a lot of time and energy introducing programs that fall under the moniker of day one certainty to increase the simplicity of the process. I think anyone who's gotten a loan recently knows that it's a complicated process. It's paper intensive. And so we want to increase the simplicity of the process and the certainty for our lenders who are making loans. So in other words, when you collect data, it's validated up front, and you feel good about that. And that drives costs out of the process, which is good for the industry and good for affordability. The other way we focused on affordability is through access to credit. And so the challenge we always face is we want to make sure that borrowers have access to credit financing, but we want to make sure that we do that in a safe and responsible way so that credit-worthy borrowers are getting into homes. And we've done a lot of work to understand the next generation of home buyers, and then based on those learnings, introduce sort of test and learn experiments as part of our work. So in fact, we've actually launched about 30 different individual little pilots to test changes in the underwriting process, to understand their impacts on loan performance and increasing accessibility, particularly for the next generation of home buyers. So for example, sourcing your down payment by agreeing to rent a room on Airbnb. Sort of a quirky idea, but a way that people can get over a hurdle that we see in the market today of down payments because, frankly, people are facing such high rental costs because of rental shortages that they're not generating down payments like they have in the past. We focused a lot on student debt issues and how student debt impacts underwriting. I'd say a lot of those programs have been successful, and as you're doing test and learn, some won't be. But the thing that we're really thinking a lot about now, and thematic of a lot of what we've heard today, is that access to credit does not necessarily equate to affordability. In fact, the more we focus on increasing demand for housing and open the doors for more people to get access to financing, the more we increase demand for housing. And of course, without an increase in supply, demand is pushing home prices up. And so for us as a company, we see demand as being very strong, and we feel we're in a very good place in terms of access to credit. But our focus going forward now is entirely focused on how do we as a company help address this big problem of supply and inventory.
And how do you think about that, the supply and inventory question?
So it's really about what are the drivers of the supply and inventory shortage, and we've heard a lot of them today, right? And for example, one stat that we were looking at is the single-family rental shift, which is a result of a lack of rental housing, has taken off the market 10 years of construction worth of starter homes. We're seeing issues of people rebuilding their existing home as opposed to moving up. And so what we're really trying to do is understand what the core drivers are, and then where we can act or where our partners can act, getting together and trying to address those key issues.
Yeah, and on the demand side, one thing that came to mind as he was talking was, when we first rolled out something to create the ability for a homeowner to apply online on their mobile device, and get an idea of what they can afford and how, get a pre-approval letter they can show to a realtor. The biggest users of mobile, which we assumed would be the lower age demographics, millennials, actually turned out to not be the highest user of mobile. The highest correlating factor to mobile usage was income. Actually, it was inversely correlated to income. and a low to moderate income consumer, was 3 times as likely to use their mobile device to apply for a home than the high income consumer or the average consumer. And I think part of the reason for that is that creating transparency, in the ecosystem is really important, so that a consumer who may not even assume that they have no idea, may assume that they can't ever afford a home. There are programs in place that are lower than 20% down that Fannie Mae puts in place, others put in place that could get them a home, but they just don't have any idea, and so they don't ever participate in the system. And so creating that transparency is something that we've put a lot of effort and thought into, and MBA as well has put a lot of thought into.
Yeah, so when we think about this problem, there are a couple of dimensions. One are the market obstacles or barriers, right? And one of the most fixable is the knowledge gap. So you have a lot of aspiring home buyers right now in the marketplace who are qualified, but they just don't know it. They've bought into these myths. It's particularly true among first-generation home buyers, that you have to have perfect credit. You have to have 20% for a down payment. And that's not true. So by working with realtors and home buying counselors and other lenders at point of sale, and technology companies, right, because that's a great tool for those people out in the marketplace at point of sale with the consumer, help educate that consumer that you may be qualified already, and there are down payment assistance programs out there. There are programs that help with closing costs. And then there are a lot of borrowers who are close to being ready. They just don't realize it. With a little bit of counseling, they can be ready in a relatively short period of time. Again, that's where the tools help. And then the other dimension that I have to address is regulatory barriers. And Mark Calabria did a good job of talking about how lenders are engaged in defensive underwriting because of all the regulatory and legal risk as a result of the Dodd-Frank rulemakings. And those rulemakings were important because you needed better protection in the marketplace to correct for the abuses from the crisis. But in many respects, you've seen an overcorrection, and you've squeezed innovation and responsible risk-taking out of the marketplace. And so we need to recalibrate those rules and allow private capital to come back in, and for lenders to kind of reach down the credit spectrum in a responsible way to promote sustainable home ownership. But that's got to be part of the equation as well.
Do you see that, private capital being something that, what do you think about private capital entering the space, and from Fannie Mae's perspective?
Well, I mean, we have certainly been committed to introducing private capital in a variety of ways. I think when we look at some of the challenges that we're trying to solve, it's not all going to be resolved by the way that we bring in capital or by public capital, if you will. I think private capital is incredibly critical to addressing issues like supply.
Got it. And yeah, real quick lightning round. I'm going to ask each of you to give your sort of bold. I said that it's $8,000 to do a loan today, which for a $150,000 home, that's something that is at the lower end of the spectrum, would be 5+% of the home value right there. What is your bold prediction for 5 years from now? What's the biggest thing that's going to drive some sort of impact 5 years from now, and what's the impact it's going to drive?
Yeah, before I boil that down in a sentence, I'll just point out that one of the things that I think a lot about is today the millennial generation, the most common age is 26, right? For the statisticians, that's the mode of the distribution. And despite the common knowledge that they're going to not get married till they're 50 and not buy homes till they're 60, the fact is they're buying homes now. And in 5 years, a lot of them are going to be getting married and buying homes. And so we've got to be ready with supply when that generation starts buying. Otherwise, this supply issue we're talking about will be a supply crisis. And so, my thinking going forward, and sort of if I had to encapsulate it in one sentence, is, we need to continue the hard work we're doing, reducing transaction costs and ensuring that all creditworthy borrowers across the country have equal access to credit. But we need to balance those things which are increasing the demand side with an increase in supply that's commensurate. Otherwise, we're just going to see prices continue to go up, and we're going to see home ownership become a thing that rich people do, and not that something everyone can do. And as we know, it's an important gateway to building wealth. And so supply, building that in the next 5 years, and making housing equal is really what we're focused on.
So if I can take the liberty of a short preamble for my one sentence as well. So, the punchline is, you got to deal with the unfinished business from the financial crisis. Is how do you rebuild the secondary market? What do you do with Freddie and Fannie in the future? And MBA in April put out a 50-page plan, and 10 pages in that plan, and there's some papers over there, copies of the paper, but 10 pages deals exclusively with affordable housing. How do you create a framework in the new secondary market to promote access to credit and affordability? And the GSEs have traditionally played in the space of the 50% AMI with affordable rental to 120% AMI. And we think that's their sweet spot, and the new secondary market regime should be there. But you got to coordinate it with other stakeholders, with FHA, with RHS, VA. So you're not just redistributing market share, but you're actually expanding market opportunities and facilitating economic mobility along the whole continuum. And so at the end of the day, the number one thing that we think can be done over the next 5 years long-term to promote affordability is to solve for GSE reform and to create an affordable housing framework that works within the whole system.
Great. Thanks, Fannie Mae. Thank you, MBA. Thanks, John. Thanks, Steve. Appreciate you guys coming.
Great.
Thank you guys very much. Appreciate it.